Hello, everyone, and welcome to the October Research Keys to Real Estate podcast. I'm your host, Mary Schuster. Our guest today is Dr. Mark Calabria. If you're not yet familiar with Dr. Calabria, you'll want to be. As the former head of FHFA, he had responsibility for the oversight of Fannie Mae and Freddie Mac. His views on making those institutions healthy enough to come out of conservatorship will interest you. This conversation was recorded at the recent National Settlement Services Summit, and in it we discussed some of Dr. Calabria's philosophies on governance and monetary policy, because he's an economist too, his views on the value of title insurance, and his prediction of whether the pilot program to eliminate the requirement for lenders' title insurance on certain transactions will survive. Now, while we didn't discuss the recently announced request for information on closing costs and junk fees by the CFPB, I think you'll find his views on the timing of these types of initiatives valuable. We also discussed Dr. Calabria's terrific book, Shelter from the Storm: How a COVID Mortgage Meltdown Was Averted, in which he recounts how a posture of loan forbearance rather than loan forgiveness helped to prevent a system collapse similar to the 2008 meltdown and its aftermath. Now, Dr. Mark didn't say this, but plenty of others have. Depending on how this fall's elections turn out, we might see him back in the realm of government once again. So understanding his Article I constitutionalist views is more than merely interesting historically. It might also preview a bit of the future, too. So please enjoy my conversation with the engaging and the ever so thoughtful Dr. Mark Calabria. The presenting sponsor of the Keys to Real Estate podcast is RamQuest. RamQuest fosters a customer-first culture built around an unwavering commitment to provide solutions that don't just meet, but exceed expectations. RamQuest's newest title and settlement production solution, Horizon, delivers unparalleled efficiency, robust features, and scalability to ensure you have tools to boost productivity and elevate performance like never before. Horizon streamlines your operation with secure 24/7 access, automatic updates, and all the power that only the cloud can offer. Plus, Horizon offers a direct connection to the industry's most extensive network of service providers and partners. Experience Horizon for yourself when you visit ramquest.com. And now, please enjoy the show. Thank you. Thank you so much. And thank you for being with us today.
Mary, it's such a pleasure. Congratulations on the new podcast series.
Thank you. We're excited about it. And these are some very interesting times that we're living in, kind of like the old curse. May you live in interesting times. And I'm really looking forward to getting your take on a lot of the events of the day. But first, I was wondering, could you start by sharing a little bit about your background and what led you to your role as the director of the FHFA?
Yeah, a great question, and it really goes back to, I finished undergrad in that aftermath of the savings and loan crisis in the early 90s. Mm-hmm. And, one of the reasons I went on to do a PhD, I should say as an aside, I started out as an accounting major. Both my parents were accountants. Cool. But I quickly learned that I didn't have enough personality to be an accountant, so I had to go in economics. But again, one of the reasons I went to grad school was that jobless recovery. Mm-hmm. And so for me, a lot of my life choices really kind of came out of a real estate boom and bust. And it's always something that kind of kept in the back of my mind. When I came out of grad school, thought about teaching, as many people with PhDs do, but ended up working in trade associations, worked at NAHB, National Association of Home Builders, was my first job out of grad school, National Association of Realtors, and then worked on Capitol Hill for 8 years on the Senate Banking Committee, first for Phil Gramm and then for Richard Shelby, and was really there in the build-up for the next 2008 crisis. And in fact, I can still remember on a Sunday night in 2003 getting a phone call from a Freddie Mac lobbyist telling me that Leland Brenzel was going to be fired the next day. And it was like, oh, and then it began. And so we spent 5 years trying to create a new regulatory structure for Fannie and Freddie, which we ultimately put in place in 2008. But a lot of the theme of the book and a lot of the theme of my career, if you will, is taking, my responses and concerns and criticisms of 2008. So a lot of my job on the committee in Congress was to essentially bring the regulators up and say, what are you doing? And of course, them ignoring me and doing what they were going to do anyhow.
Of course.
So as regulators are.
Yes.
And so I really kind of had a lot of strong feelings about how HAMP and HARP and many of the responses in 2008 were done, and really said to myself, if by chance I ever find myself in the seat, we're going to do it differently. And lo and behold, as fate would have it, I ended up being confirmed at FHFA. Interestingly enough, when I walked in the door in April 2019, I said to the senior staff, I know a lot has been done on servicing since 2008, but I've been outside of government. You need to convince me we're ready. And we immediately started a review of servicing, which obviously ended up being, at the center of the 2020 crisis. And of course, in that time, ended up 2 years at the White House, worked on taxes and trade, worked on USMCA, the deal we did with Mexico, worked on the 2017 tax cut. So if you got a tax cut out of that, you're welcome. If you didn't, sorry, maybe next time. We'll come up again in 2025. But, again, I had a really just amazing opportunity to be able to work at the White House for 2 years and saw lots of fascinating things. But at the end of the day, it was a tremendous privilege and opportunity to be able to run FHFA, especially, as I said, is noted, during my time on the Hill, I helped draft the legislation that created FHFA. So almost felt like a parentage with it. Sure. To me, I had spent 5 years of my life on Capitol Hill getting the agency created. So I came in with a very strong feeling of, I want this agency to be a success. One of the things I would say to the staff at FHFA pretty regularly is that when I was on the banking committee, people would find me all the time in terms of having problems with their mortgages. So, the dishwashers from the Senate dining room found my office and would bring their HUD-1 and say, and you'd literally be sitting across the table from a dishwasher with 4 mortgages, and you'd say, how did this happen? And so for me, I got really first-person experience of what happens when the process doesn't work well.
Yeah.
And one of the things I would always say to the FHFA staff is we are responsible when the mortgage market and the real estate market doesn't work well, real people's lives are impacted. And of course, when it does work well, this is a key to homeownership, it's a key to being a wealth creator, it's a key to having control of your life, it's a key to sometimes being in good communities with good schools. But, and that's all important, we should always focus on that, but we should never lose sight of the cases where it goes badly. And making sure the process works. And I should also note during that time, I spent a brief year at HUD with Mel Martinez 20 years ago when we were trying to do RESPA reform. So all the efforts to try to package and try to deal with those Section 8 referral fee issues, all that stuff. I went through that. Yes. I try to block it out of my memory most of the time. But, and again, as we know, RESPA has since then moved from HUD to CFPB, the Consumer Financial Protection Bureau. But it's always been something that's the heart of what I've been interested in, is the importance of housing and real estate in our lives.
It is so important, and of course everybody here lives that every day, and it's wonderful when we hear that our regulators get those firsthand interactions with the consumers that are impacted by what you decide and what we do every day. There's a high degree of relevancy there that I think probably not everybody in an agency role gets to experience, and I love that you did. And I'm wondering, during your time at FHFA, what were some of the key challenges that you faced in overseeing Freddie and Fannie?
It really was, for a number of reasons, a troubled agency. I mean, to some extent, I'll say it aside, as you may remember, one of my predecessors had a sexual harassment lawsuit against him at the time. We had to settle that and resolve that, and it divided the agency, hurt a lot of morale. There were questions at the time about what the future of Fannie and Freddie, the agency, were going to be. So, I was taking over an agency where people weren't even sure that agency would exist. So tremendous amounts of concern, confusion. Fannie and Freddie had gone into conservatorship in 2008, which had concerned essentially an administrative bankruptcy. Mm-hmm. So they've been in bankruptcy, if you will, for
they were just going to
decade.
pass through, right?
Yes, well, I mean, as the guy who worked on the statute, it was not supposed to be decades. It was supposed to be 6-7 months, not 14, 15 years. Yeah. And it really also just eroded. I joke in the book that it took me 6 months as regulator to stop saying we in reference to Fannie and Freddie. It's like, I think the regulator should engage with industry, but you have to have some arm's length objective view as well. So friendly, but not, again, trying to see the perspective, but understanding that you have a broader obligation to the public. And the conservatorship really had eroded that. There really wasn't a sense of identity at FHFA as regulator that was separate from Fannie and Freddie as companies. And you also had, you may recall, there was something called the profit sweep that was put in place, and it had really eroded the company's ability to think in commercial manner. So for instance, a good example of this, while the sweep was in place, Freddie went on a big hiring spree. The second I told them, guess what? We're going to set this up so you get to keep your earnings and build capital and worry about your expenses. And suddenly they decided to lay off a bunch of people and restructure. Yeah. So it's just a different reality, like when you get the incentives right.
Yes.
Because again, we were trying to prepare these companies to go back out in the marketplace and to be normal companies. And to me, I think the conservatorship was often the worst aspects of government and business combined. And so we were trying to leverage that for the best. And also, an importance of getting them out of conservatorship is to reduce the politics around it. Again, we wanted this to be something where underwriting standards or relationships with business partners, whether it was the title industry, whether it was the mortgage industry, was really back to being based on business fundamentals, not based on whatever the political whims of the day. And I think that's become a real problem. So again, I'm a big believer in you got to just get these companies back out acting like normal companies again. It's just too distortionary of the status quo.
It absolutely is. Well, and your philosophy is somewhat unique from compared to some other regulators that we've been in conversation with from time to time. One of the things that I find really amazing is that you believe that safety and soundness should be placed ahead of short-term profits. And I'd like for you to expand on, if you would, why is that the most important thing?
So, sometimes the conversation around Fannie and Freddie argues that there's a sort of trade-off between safety and soundness mission, and I reject that outright. I think about it as, safety and soundness is the foundation of the house. Right. Well, there's no trade-off between the foundation and the roof. If the foundation's not going to stand, the roof's going to fall. And so to me, for Fannie and Freddie to be able to do everything they do, they have to be safe and sound, or that really threatens it. And we really saw this. There's a lot of concerns in the pandemic about Fannie and Freddie's ability to support not only homeowners in the broader mortgage market, but others in the mortgage finance ecosystem. And again, one of the reasons I wrote the book is Fannie and Freddie were within a hair of failing themselves from COVID losses. And like anything, it's when you're on an airplane, you put your own oxygen mask on first. And so for me, the mission really was, we've got to get Fannie and Freddie in a position to be strong for them to be able to support others. And so it's not a trade-off of supporting others. It is this comes first because it's the foundation of everything we do in the real estate finance system, at least most of it in the conforming space.
Yeah, agreed, completely. Well, so what are some of your other core principles when it comes to government and business, and specifically the housing sector?
Well, let's start with, despite having worked at the White House and ran an agency, I call myself an Article I constitutionalist, and what I mean by that is Congress makes the big decisions. I would often get queried when I started FHFA, well, what's your agenda? I'm like, I don't have an agenda. I have the law. I have what Congress has told me to do. And it could be the dumbest thing in the world, but Congress has told me to do it, and we're going to do it. And we're going to carry it out the way the Congress has decided. And so I think you clear up a lot of bandwidth in your head as a regulator if you stop second guessing the legislature. You accept that the legislature has made these decisions. Your job is to carry them out. Obviously, there's going to be some, fill in the blank areas. But, we've really, in my opinion, seen in Washington a view among regulators where they look at it and say, well, I don't agree with Congress. I'm going to do it my way. And again, my view was I'm going to do it the way our democratically elected representatives decided. Like, I was selected, not elected. And I think you have to kind of take that modesty into consideration and remember it's not your view to supersede those of Congress. And that was the first and foremost. But I think one of the things that really helped me was also having spent decades working around the fringes, again, at the association. So, working for NAR is not exactly being a realtor, but it is, you spend a lot of time studying the industry, you spend a lot of time engaging with the industry. And so I also start from both as a regulator and as a leader. I think the most important characteristic is humility. You have to start with the recognition of whatever the situation is, 90% of it you don't know. And how do you set up a situation where you can figure out what you don't know? And then as importantly, figure out the things you do think you know, but don't really know that are wrong. My staff probably got tired of me saying on occasion that I had more than sufficient confidence in my own views that I don't pay people to repeat them back to me. It's like, don't tell me what I know, tell me what I'm missing. And I think you really have to embrace that sincerely. And I think a lot of what's often wrong in Washington is people just start off with the premise of, I know everything and there's nothing you can tell me, and you're here just looking out for your own interest. I've always understood as a regulator, businesses need to be profitable to survive. It's not my job to put anybody out of business. It's also not my job to protect their market share, but it's also my job to set a set of rules where everybody can compete on a level playing field, where it's truly a fair decision, but you are modest about it and you try to inform yourself. So I spent a lot of time on the phone with CEOs and people in the industry, and we tried to be extremely open. Again, we did start from the premise of you have every right and responsibility to petition your government, but you have to make a case. Like, we never were like, oh, well, you think we're wrong? Okay, I'm open to being wrong, but you have to explain to me why I'm wrong. And I think that sometimes you get this push of like, well, I think you're wrong, therefore you should change. And I'm like, well, that's the start of the conversation, not the end of the conversation. But again, I think coming in with the recognition of there are certainly things I'm gonna be wrong about, and how do I have a process where I can hear from people and correct those. Yeah. And I think that's a big part of it. Again, I inherited an agency, there was very low morale and there's a lot of division. And you just have to be seen. You have to walk the agency, you have to engage with the staff, you have to let people know you have their back. So one of the things that really surprised me was being told by staff that my predecessors had essentially allowed the Fannie and Freddie executives to go right to the top to overrule them. Mm-hmm. I'm a big believer in, if you undercut your staff all the time, that's a killer, exactly.
Yeah, it's a killer.
As I sort of joked in the job, I didn't do anything, I just directed other people to do it. And for those people to be believed, for them to be my representatives, they needed to have my support. Yeah. So again, trying to change that culture where people felt supported really was a tough job. And then obviously in the pandemic, we hit all the same issues everybody deals with in their business, remote work, trying to mobilize the workforce, we actually expand staffing at FHFA 20% during the pandemic. So how do you bring people in, especially people coming out of college, where you're incorporating them into organizational culture? And so a lot of those things, just write about those experiences and what we learned. And I also, in the book, try to be candid about the mistakes I think we made, the uncertainties we were dealing with. And that's why I wanted to be kind of open with, here's where I was rolling the dice. Here's where we tried to be open-minded about what we did know, what we didn't know. And here's where we adjusted as we went along.
Yeah, well, that's completely fair. And many of the people out in the audience also had to go through a lot of that, so they feel your pain on that. And I think it's refreshing to hear such a pragmatic perspective coming out of DC, because we don't always hear that. I'm not saying it's that unusual, but we don't always hear it.
The sad thing is, and I mentioned I worked on the banking committee. One of the things I did on the banking committee was work on nominations. So, and I worked in a lot of high-profile Federal Reserve, like Ben Bernanke, and a lot of these people. I worked on their nomination. I got them through. Having worked on a large number of nominations, and then worked on personnel issues, recruiting people for jobs at the White House. And I'll say as an aside, not giving you a name, but I remember talking to her. A woman I was trying to get to take a position and a nomination, and she told me, Mark, okay, let me talk to my family tonight and I'll get back to you tomorrow. Mm-hmm. So I talked to her the next day and I was like, so what's the feedback? And she was like, well, my son said, Mom, you're never really here anyway, Hal, so you might as well go ahead and take it. It was like brutal. So that was like, okay. She was like, it sounds like I got to spend more time with my family, Mark. And it's like, that I understand and appreciate.
Totally gotcha.
But the roundabout way of saying, doing all of this personnel stuff, there's almost no conversation ever in Washington. And I think we're seeing the results of this today at FDIC, for instance, where there's rarely any emphasis on whether appointed people have any leadership capability at all. It's a secondary question, if it's a question at all. And I do think that's a problem in government, that we're not necessarily looking for regulators that have ever led organizations. And morale is such an important part of being an effective a leader. And again, I think a lot of the frustration, one thing that people really walked out of the pandemic with a view of is, was I treated by my organization with compassion and caring during the pandemic, or was I treated like I was expendable?
Yeah.
And a lot of, and obviously a lot of people felt like expendable. Said, I'm leaving. I'm going to go work somewhere else. Again, I think that was really some of the things that we saw a little bit more intensely. Now I try to relay some lighter moments. For instance, spent more time at home being able to listen to music and my pets and family and things like that you did during the pandemic, and certainly had an impact on the way many of us tried to deal with that. But also trying to remember that, on one extreme, you had people stuck with visitors from overseas, or 3 or 4 generations in a household, and then the other extreme, you had people stuck in an apartment by themselves for 2 years. So, how do you make sure you're reaching out to the staff? So those are some of the kind of leadership questions. And while, of course, I hope we never have another pandemic, I think many of these things do have relevancy beyond that kind of really weird environment of COVID in terms of how you engage. We're in a tight labor market in many parts of it, and even in a more moderate labor market, high performers have choices.
Yes.
And it's not always, or even most of the time, about the dollars.
Right. It's the experience, and people vote with their feet. You're right.
Absolutely, and you gotta lean into that.
Yeah, for sure. All right. Well, I want to get to some current topics.
Okay.
You ready?
Yeah, I'm trying to forget all that pandemic stuff.
I know we're all trying to block it out.
Other than read it in the book and then forget about the pandemic.
There you go. Well, there's a certain issue that many in this audience are concerned about today, and I'm sure you've heard about it. Many here believe that the programs allowing lenders to waive title insurance requirement for certain loans lands squarely in the opposite court of your notion of safety and soundness that need to be paramount for Fannie and Freddie. And I'd love for you to share your perspective on the title insurance waiver programs, and of course, as former head of the FHFA, maybe share some of your history with the evolution of that concept itself.
So let's start with this whole, attorney letter of opinion. I mean, first I'll start with, boy, I can't really think of too many instances in life where involving more lawyers is going to lower the cost. It's just rarely.
Doesn't work that way.
Yeah, let's more lawyers, and sure it'll be cheaper for the consumer.
Yeah.
At the end of the day, I'm certainly not very sympathetic to the way this has started, and I think it had actually died until it was brought back in the State of the Union. And I know some of it I know there's a real sensitivity, particularly at Fannie, but even Freddie, where they get a lot of pressure on costs in the system. And the real tension we have as a country is that the overwhelming obstacles to affordable homeownership are getting more homes built. There's honestly almost nothing Fannie and Freddie can do to move the needle on homeownership. You're not allowed to say that in Washington. We're supposed to pretend, it's apple pie and baseball and Fannie. It's like, no, the mortgage finance system, we have pushed the envelope, and that's not going to, 10 basis points off the Fannie loan is not going to get a permit approved in San Francisco to build an apartment building. I mean, you're pushing the wrong levers. But again, there's such a pressure in Washington. And so a lot of this title conversation grew out of a frustration at Fannie and Freddie that they were being blamed, like, you're not doing enough for home ownership. And of course, again, they can't.
Yeah, the magic wand they do not have.
The levers are outside of their control, so they look for the things that kind of are in their control. And of course, I'm going to set aside that the last time I looked at a HUD one, that the transfer taxes were probably the biggest. But I live in DC, so I wish we could do something about that.
Sure.
But all that said, so it really was a focus on where are the pieces of the transaction, and of course, obviously with the realtor, this is the same reason that NAR and the Real Estate Commission is under attack as well, was that you had this approach of trying to go after certain elements. And again, keep in mind, even if this effort was right, let's say you lowered the realtor fee, let's say you wrote the title, you're simply enabling the borrower to bid up higher for the house price. So I kind of characterize, I think, the approach in Washington right now is to look at two families vigorously bidding over one house and to say, let's add a third family, rather than say add a second house. And again, I just think that the approach here has been the wrong direction. Now, but even that said, from a safety and soundness perspective, there have been variants of this where, the attorney letter may have Fannie and Freddie themselves take on more of the actual title risk. And again, these are companies that are massively leveraged, that don't have enough capital on their balance sheet to support the risk they're already taking. So to me, certainly, if you're a safety and soundness regulator, you should be thinking of ways to push the risk out of Fannie and Freddie, not to have them absorb the risk. But I do think one of the reasons you need a strong regulatory structure, and I would have this conversation all the time, particularly with Freddie, but even Fannie, where they would always come into me and say, we want to be big innovators and tech companies. And I was like, okay, what's your proposal? And then they would come in with some suggestion like, oh, here's 5 other people in the value chain who we're going to leverage our government guarantees and benefits to run them out of business. And I'm like, I don't see the innovation in that. Maybe it's just me. I don't see nothing, anybody can do that.
Okay.
So come back to me with something that's truly original and innovative, and you're not just eating somebody else's lunch.
Yeah.
And again, I think they had so much had this mindset. And unfortunately, you see this, like the pressure to do away with appraisals, to do with title. And it's very frustrating to me in that the conversations I had with these companies, their view was all of these other things in the process are frictions. And we're going to smooth out the frictions.
Oh, I just thought we were junk fees. It turns out we're frictions.
Yeah. So that's, it is. So again, to me, the whole incentive of checks and balances and having somebody make sure that the loan or make sure that there's clear title. I mean, all of these things, they just go, well, that just slows the process. And God forbid we wait one day to get somebody into the biggest purchase of their life. And there really is this kind of crazy, again, I'll be the first to say, a lot of my perspective is driven by watching people being put through the ringer post 2008. Yeah. And my view is this is a really serious thing to put someone in home ownership. Let's do it right. Let's not rush it. The notion that, we're going to move all the frictions and, we're going to worry about, I know, again, I would look at it like, you're kidding, come on. Just trying to have this conversation with them. And unfortunately, there is this real tension. Anytime you listen to Fannie or Freddie say, client or customer, they're not talking about the borrower. They're talking about the originator. Yeah. And that's who they look out for. And again, I got nothing against mortgage originators. Sure. Great people.
We love them.
But at the end of the day, their job is close that loan, move on to the next one. Yeah. And their job is, especially if you're a non-bank, it's sort of funny, the number of times I would talk to a CEO in a non-bank or mortgage originator, and they'd say to me, Mark, at the end of the day, cost can be this, cost can be that, as long as I'm same cost as Wells or Chase or B of A, and just don't make me uncompetitive. And they're really, I'm sad to say that 80% of the conversations in DC around Fannie and Freddie are really about originator market share, about who could be in a better spot than who. And maybe 1% of it is about, are we putting the borrower in a sustainable loan? Are we making sure that there's not some legal problem such as title, or whether they're going to be able to pay and sustain the loan if property insurance rates go up? Right. So I do really worry, and to me, I think there's a lot of patches. Again, I'll say on the side, typical borrower is in great shape. The number of people who have 50, 60, or percent equity in their homes, huge number. But it's a reminder, the median, the typical subprime loan paid throughout 2008, it's not the average borrower, it's the tail. It's the small percent you need to be worried about. Just as most home transactions, there's never a problem with the title. But that doesn't mean you don't go without insurance. You have to look at the tail risk. And Washington today is really ignoring a lot of tail risk in the mortgage market, in my view.
Yeah, I agree. Well, I've been thinking about that State of the Union situation you mentioned there. And you've headed up an agency, as we've well established. And so I'm wondering, how does something typically land a spot in the State of the Union address? You as the director, do you just pick up the phone and say, call the outer oval and say, get the president on the blower, I've got a great idea?
Well,
or how does that
so
work?
Let's start with when I was at FHFA, we were an independent regulator and really had our view that we were independent of the administration. But I did spend 2 years at the White House, and State of the Unions are very White House driven. And so there may be a call somewhat to say, what should we include in this? And, my read, and this is a bit speculative, is that the whole attorney letter thing was dead. Mm-hmm. And then the White House looked at this and said, the polls are horrible, housing's unaffordable, people are really mad at us about housing prices, and they should be. I mean, look, housing is unaffordable in many parts of this country. And they looked at it and said, we need to say some things about housing in the State of the Union. Who's got something? And then someone said, oh, let's put this attorney letter thing. So I think this one really came back not because of FHFA. I think it came back because the White House was looking for things that it could throw out there in the State of the Union and talk about, hence the whole junk fee thing. But I certainly will not. It's important to keep in mind there's a very different culture at FHFA than at CFPB.
Okay.
So FHFA is very, I mean, they're generally, even sometimes too industry friendly, certainly with originators. But they essentially want the process to work. CFPB, it is a guilty till proven innocent. It is if you were in the business and you were in the real estate sector, you're probably ripping somebody off we haven't figured out yet. And there really is a very big suspicion. I'm going to set it aside as a legal issue. Important to remember things like RESPA, TILA, all these things, they're disclosure statutes. They are not pricing statutes. And so you've seen this approach where there's been an attempt at CFPB to try to create leverage on pricing issues.
Yes.
Like, for instance, whether you think something's a junk fee or not, it's on the good faith estimate. It's on the HUD-1. It's disclosed. That's how RESPA works. It is not a, is this too expensive? It is a, did you pay what people told you you're going to pay? So even the way it works, yes, we've got tolerances around fees, but at the end of the day, if it says, you know, $10.50 on the good faith estimate and it says $10.50 on the HUD-1, it's legal, whether you think it's a legitimate fee or not. And I really do worry that you've seen a very aggressive CFPB, and obviously we've seen the Supreme Court now rule on its funding, and I think you're going to see a very aggressive approach from CFPB, you know, on RESPA issues, trying to use, again, fundamentally a disclosure statute in a way where they're going to try to control pricing. So I would say, you know, you got to be extremely careful, and it's not just enough to make sure that what's on the good faith estimate is it mirrors with the HUD-1. It's not enough anymore to just simply make sure that the consumer gets exactly what they paid for. There's really going to be a lot of pressure on, is that a reasonable cost? And they're going beyond RESPA to use their authorities under reasonableness, unfair, abusive, and of course they're completely unwilling to even tell you what abusive is.
Yes.
It's a sort of like, you know, we'll tell you when we sue you.
Yes.
And to me, it's really, getting back to my own philosophy, you know, I'm not a lawyer, but my approach to government was to say, you know, channeling maybe a little contract 101, the party that holds the pen holds the responsibility for clarity.
Yes.
And I always thought as a regulator that me as a regulator, if it's unclear, you can come back and tell me that, and I can rewrite it. And I believe that should be the approach CFPB takes, but that's not the approach they take. The approach is like, you know, we will let you know when we think it's unfair or we think it's wrong, and we're not going to tell you until then. And maybe, if you're lucky, we'll allow you to cure, but we might not. And you know, so it really is an attempt to keep you on your toes and to keep you guessing. And again, my view is that as a regulator, my view is you should be providing certainty. It may not be the answer people want, but it should be a clear answer that allows you to plan your business around it.
Yes.
And I really tried to make sure as a regulator that we were extremely transparent. Again, so transparent that I wrote a book and told you why we did what we did. But also at the time just tried to say, this is exactly what we're doing. And if it's wrong, tell us, we'll change it. But we didn't want to have people guessing. So I really do worry that there is fundamentally a philosophy currently at CFPB that is you'll find out you're wrong when we sue you. And I think that is just so counterproductive. And finally, I think a core American value is you were innocent until proven guilty. And I do think a lot of the CFPB approach is counter to what I think are core American values.
Well, and it to your first point, it is a very difficult climate to do business in when there's kind of, And
I do want to emphasize, sure, in every industry there are bad actors. Go after the bad actors. In fact, I would say, there's enough bad actors to keep CFPB occupied. Why are they going after people who aren't bad actors?
I'm sure everybody here feels that same way.
I'd like to think we all believe that people who are truly defrauding and ripping off consumers, there should be punishment, there should be penalty. Well, do that.
And guess what? The market wants those people handled too. We don't want those actors out here in the marketplace.
They tarnish you, and you get ripped off. So. Nobody's saying stand down and ignore bad behavior. What I'm saying is, anybody in a business should be able to know whether you're on the right side of the line or not. Because you're getting dinged for things that you in good faith were trying to do correctly.
Yeah, you're right. Well, Freddie Mac has sought FHFA approval to begin purchasing and guaranteeing HELOCs when they already own the first mortgage, and I would love to hear your thoughts on that.
I mean, let me say, as a legal matter, I think it is charter compliant. They can do it, but that's a secondary. So the statute also requires them to make sure that it's consistent with safety and soundness. And obviously, seconds are riskier than first. They don't have the capital to support the first. There's no plan that I've seen for them to raise capital while finding a way to offset the risk. So my read of this is for them to go forward with the seconds is an implicit recognition that they're going to stick the taxpayer with the losses. And I think that's counter to the statute. I know this, after all these years in Fannie and Freddie failing, the law is actually pretty clear. Fannie and Freddie aren't supposed to lose money. They're not charities. They're supposed to be run as private businesses, and the taxpayer is never supposed to put in a dime. And I believe that they're not being run in that way now. They're being run in a way that's counter to statute.
Is this a solution in seeking out a problem? I mean, I don't
see any evidence that there's a failure here. I mean, I understand that some of the motivation are some non-banks who would like to. I mean, mortgage market's down.
Yeah,
Sales are down.
We've heard.
So, and again, if I'm the CEO of a non-bank mortgage lender, and the choices I lay people off or I lobby to have Fannie and Freddie, let me into a new business line, I'm going to lobby to have Fannie and Freddie put a new business line. I don't blame. I've never even as a working on the Hill, working the regulator, I'm a big believer in people should be able to advocate and argue to their government. That does not mean, however, that the regulator should give you what you want. Right. And I think there's no real policy argument for this, even though I think it's charter compliant, but I do not think on a safety and soundness bounds that Freddie is in the financial state to be able to, where they should be allowed to do this. Maybe 5 years from now, maybe 10 years from now. But to let them do this in the state they are in today is inviting them to blow up.
Yeah, I think everybody that's sort of in this room innately understands that, but I think it's part of a conversation we need to be having more, both with our contacts in DC and even in our own marketplaces, because I'm not sure people understand really what this means and or that they're even really going about it. That's been a little quieter on the radar screen than maybe it deserves to be. One of the things that Dodd-Frank was supposed to do was sort of kill the notion of too big to fail. If you were going to give it a grade card, what would you give it on that?
I'd have to give it an F. I mean, look at last year Silicon Valley Bank. I mean, this is crazy. We bailed out billionaires. Let's start with if uninsured deposits in Silicon Valley Bank had not bailed out, the people would have gotten 90 cents on the dollar.
Right.
And that, to me, that's not the end of the world. You got 90 cents back you put in. I'm not unsympathetic, but that's the whole. It's called uninsured deposits for a reason. And so I do worry, and you just saw a proposal from Treasury and FSOC to create a bailout facility for mortgage servicers. And so I do worry that the approach to everything is now, well, don't worry about taxpayer, just take the downside. And I find that deeply troubling. Again, to go back to fundamental American values, if you're going to take the upside of a business, you got to take the downside. And let me tell you, if you think you're going to just get away with the upside and stick the taxpayer downside, eventually it's going to catch up with you, because Washington does not give you anything for free. And it's eventually going to come back, and you're going to see people regulated in a way that's going to be extremely costly. So what I tell all my non-bank mortgage friends, you don't want that backstop. You get that, then there's going to be a whole regulatory structure that comes with it that's going to be extremely expensive for you. It'll be great for the lawyers. Everybody else is going to suffer and costs will go up. So again, I think we do need to get back to a system where, if you take the upside, you take the downside, and we have a system where bad actors can get weeded out of the system because they go bankrupt. And I think we need to get away from this view of the government providing a safety net for all sorts of risk taking, because to me, that's not capitalism, it's socialism.
Exactly right. Well, I do not want to be selfish
No,
because I could talk to you for 2 more hours and ask questions, but I wanted to open it up to the audience for questions. And as you're making your way to the microphones, if you have questions, there are a couple of people who ask us questions through our snazzy app, so I'm going to ask those first. Is Stephen Green in here, by the way? Anybody that asks the question gets a autographed book from Mark. So be thinking of a question. Stephen Green did ask on the app, is there any merit or concern for what Biden proposed and the removal of the title insurance requirements on certain loans? upside?
There is a lot of Washington concern. It's not a done deal, and I think there's been a lot of pushback from the Hill, and I think it's running out of steam. And quite frankly, I think it's purely an election issue. So I mean, if Trump gets elected, it completely goes away as an issue. If Biden gets reelected, I think it mostly goes away as an issue. So this is really an election.
It's good from now till November, we
pretty
think?
much. That's the way you should think about it. That's not that you shouldn't ignore it and still be concerned about it, but it's mostly an election year issue.
I thought there'd be smiles and applause at that one. Okay,
Well,
tough crowd.
November's a ways away.
Yeah,
so,
that's true. We got to hang on till November.
Anything
Okay, I
lot's gonna
got
happen
it.
between
I got
now
it.
and November.
Oh, there's some applause.
There
Thank
go.
you. Yeah.
There you go. Okay.
Is Abby Nichols in here? Abby asked a question. We'll have to get her a book. Will we ever have policy that bridges the gap between consumer needs and corporate interests?
You know, I think we can, because I don't think those are inherently in conflict necessarily. I think they can be when they're short-term thinking, but I think fundamentally, you know, running your business in a way where consumers want to come back. I mean, you know, the vast majority of pieces of the real estate transaction, whether you're a realtor or a title agent, you know, most of your business is reputation. And often your business is because someone recommended you or referred you. And so maybe it's a little naive, but I think having a reputation for honest dealing and being straightforward with people is self-reinforcing. And honestly, one of the reasons I'm so adamantly against corporate bailouts is because I believe it keeps corporations and businesses with bad cultures around. Because I do ultimately think if your business model is ripping people off, sooner or later people catch up and you go out of business. Unless, of course, the government comes in and decides, oh, we can't let you fail. We got to, like, you know, I mean, again, Silicon Valley Bank was a just mismanaged institution. It should have gone out of business. And the fact that we came in and saved some billionaire depositors, I think, is completely counter to wanting to weed out poor business practices. So I'm sympathetic to the concern, and I would simply say, you know, I think we need to have a system where those things are more in alignment, and they can be in alignment.
Does anybody have a question for Dr. Calabria? I have a question you are an economist, so I'm going to take advantage of that side of your brain too. What in your mind, what should interest rates be doing, and when do you think they'll be doing it?
Wow. Let's start with the latter part of that, and I think you know, maybe rephrase that. I think you're asking me, when do I think the Fed will make a move? Mm-hmm. I think at this point you're not going to see a rate move either way until after the election. December is probably the earliest. Inflation has been much more stubborn than I think the Fed has wanted. And I've had my disagreements with Chairman Powell, but I think he is focused on making sure that when he leaves, he hands over the Fed and inflation on target around 2%. So there's a real push to try to get inflation back around 2%. And again, it's been a bit stubborn. I don't think we're going to really be there till later in the year. So now the plus is I've seen a few surveys where less and less homeowners are kind of waiting. You know, remember a year ago, all of our realtor friends were saying, you know, marry the house, stay at the rate.
Right.
I think at the point where a lot of borrowers are just starting to say, you know, if this is the house I want to live in, I can afford it at this rate. And so I think we're starting to see more and more people decide to come off the sidelines. Not everybody, obviously, but more and more people come off the sidelines thinking, you know, 6 months is not going to get me a lower rate. I'm going to pull the trigger today. So you need to just get people comfortable with that as consumers.
Yeah.
We're definitely not going back to 3% mortgages.
No, we're not.
I don't know if we have a question over here.
Yes, hi.
Sticking with the Fed and trying to tame inflation, any concern with the HELOCs, you know, being insured and turning back the faucet, money being sucked back out of their equity, their houses, is going into the market, raising prices? Any concern on your end?
I mean, I am. I mean, again, I would say my primary concerns are really safety and soundness, but you get at an important point, and it's a frustration I have with Washington. You know, Washington often looks at it. So let's start from the premise of a lot of the inflation is because we've pumped a tremendous amount of money into the economy, and obviously we've got supply limitations, not just in housing, but across the board, and that money bids up prices. And so the response of the administration has often been, oh, well, prices have gone up, well, let's just give people more money to afford it, and then it ends up more bidding. And so absolutely, to the extent that you're enabling people to take more money out of their homes, you're going to allow them to bid up costs in the economy. And in fact, I mean, I mentioned this in the book. I very consciously put my thumb on the scales in 2020 and 2021 to say, I'm going to make it harder to do cash outs versus rate refis. A, because Fannie and Freddie didn't have the capital for more risk. B, because we were already pumping an insane amount of money in the economy in late 2020. This was, again, keep in mind, by July, August in 2020, the job market was shooting back up. The point of, assistance that made sense in March and April did not make sense in August and September. But we still kept pumping money into the economy. So absolutely, we're this second. Again, let me say this aside. I think some of the bigger estimates, Bank of America maybe has said they think this is a $3 trillion market. Let's keep in mind the constraints. You have to have a Freddie loan already, and then the second and the first can't be above 80, and it's got to be underwritten with an appraisal. So you can start from the premise of nobody with a second under, say, 50, 60,000 is going to make any sense. No, it's not going to make any sense to do like a $10,000, $20,000 mortgage here. So how many households really have like $100,000 in equity in addition to their mortgage that keeps them under 80 LTV? That's a small number.
It sounds kind of like the cream of the crop, just like that wouldn't need title insurance.
It really is. It's kind of like, how do we come up with more? I mean, again, I've worked for Republicans, but my inner progressive is, this is just what we need, more assistance for rich people. Again, can we just focus on, again, how do we triage those who are actually in need? Because this is not helping anybody on the margin.
No.
It's like, the student debt relief for lawyers and doctors.
Not to get started. You're welcome, lawyers and doctors. You're welcome. Hey, lastly, because we do have to get to our evening activity, but I was reading in the Wall Street Journal a couple weeks ago that one of our major presidential candidates, perhaps one you know.
I know a couple of them, actually. But
has some folks around that are working on a plan to get the president perhaps some more say with regard to what goes on at the Fed, maybe weigh in a little bit on what the rate should be. What do you think about that?
So again, the Fed obviously operates in conjunction with the administration. So, it's as I think it was Greenspan who used to say, not independent of government, but independent within government. And certainly so there's some questions about how do we have better coordination with the Fed, certainly concerns about how does that impact dollar policy, concerns about, how do you make sure you have nominations. So I talk about this in the book because I was part of the process that debated whether we should reappoint Yellen, and that ended up having Powell. And one of the reasons that we went with Powell rather than Yellen was we thought she simply had a different model of economic policy than we did. And so you don't want to have the Fed working at cross purposes. You want to have them working in a way that is consistent with the policies that are being taken on the fiscal side. And so again, you want to make sure that you're kind of aligned philosophy. This isn't about micromanaging the day-to-day activity of the Fed, in my view.
That's fair enough. Well, we thank you very much for this conversation today. We appreciate you joining us at NS3.
Thanks again, Dr. Calabria. We appreciate your candor and your making the time to let us know how your reasoning influences your decision-making and policy positions. I truly enjoyed our conversation. Now, listeners, you can follow Dr. Calabria on X, formerly Twitter, at Mark Calabria, and that's MarkCalabria. And if you'd like to read his book, which I highly recommend, it's fascinating. It's available for purchase at the Cato Institute's website or on Amazon. We'll drop a link to the Cato Institute's bookstore in today's show notes. And if you haven't yet attended the National Settlement Services Summit, we'll link this year's agenda in the show notes also. Because if these are the types of speakers and information you need to understand, maybe you'll join us at next year's summit. It's a terrific place to learn. Thank you for joining us today. We'll keep bringing the guests and topics that help you successfully hold your keys to real estate. Until next time, I'm Mary Schuster for October Research, where knowledge is the competitive advantage.